Welcome everyone to our session today. Our topic is the value of a practice, what you need to know about selling your practice. And the reason this topic's come up today is that I've had an alarming number of people ringing me asking what to do to sell their practice. They've either got an MOU from a corporate or they're preparing exit agreements out of an existing practice and they're just not sure how the valuation is going to be calculated. So I got on the phone to Matthew and said, I think we should talk about this. And the number of you guys who are registered today shows it's a real topic of interest. So thanks for coming along. Thanks for watching the replay if you can't come along, and we'll get started. You'd be disappointed if I didn't do a legal disclaimer. I'm a lawyer. So this presentation is for general guidance only. We won't be diving deep into anyone's specific issues. And we always do recommend that legal or accounting advice be taken in relation to actions on specific issues. So this is more an educational session. And who this session is for you if you're a practice manager or practice owner or a practice manager and you'd like to learn. We do find actually there's a lot of practice managers who are also practice owners, and you'd like to learn how to determine the value of your practice for sale or succession, the steps involved in selling your practice, how to maximize value when leaving a practice that has multiple shareholders or stakeholders, and the rights and responsibilities of fellow owners and shareholders when you're leaving. Because when I was thinking about this, I thought, gee, it must be interesting if you've got a shareholder that's leaving and all of a sudden their interest is to maximize their value. But if you're staying, then you're thinking, how does this benefit me? I'm paying a high price. Is it right? And is there a conflict also between the outgoing shareholder that just wants to maximize their value and me as a continuing owner? So I thought that could be an interesting topic to go into too. Now I'm going to hand over to Matthew Holden so that he can introduce himself to you.
Thank you, Sarah. Thank you. And thank you to everyone who's come on board today. So looking forward to the next 45 minutes, hour, how long we take just to go through, because as Sarah said, we get a lot of questions in regards to this matter, and it can be quite a process when you get stuck into it. So it's important to know some of these things from the outset. Look, just a little bit about me. My name is Matthew Holden. I'm a partner here at Brentnalls SA, Chartered Accountants. We've got our own health division we call Brentnalls Health, which are a team of us accountants, and we've got some non-accountants that work for us in practice management consulting that work with our clients, predominantly GP specialists, and also do a fair bit in the veterinary and dental world. But across the whole of the gamut of the health spectrum, we like to get involved in, and have been involved in a lot of both sides of the transaction. So clients who have had practices for a number of years and looking to sell or to bring the next generation on board, and then also those who are looking at practice ownership for the very first time and just want a bit of guidance around the numbers side of things. So that I get great value out of helping my clients in those matters there.
Great. And for those of you who don't know me, my name's Sarah Bartholomeusz. I am a lawyer that specialises in helping doctors protect their practice, their patients and their profit by using legal documents, which is why we're here today. My book that I wrote recently called Growing a Medical Practice from Frustration to a High Performance Business is currently being edited as an audiobook as well, which is really exciting. And my passion for working with doctors comes from being from a medical family. I'm a bit of a black sheep in a medical family, and wanting doctors to get the best possible advice and know that people who help them from a legal perspective are really on their side, because I've seen through my own family members where that hasn't happened, and the professionals involved have been thinking more about lining their own pockets than helping doctors. So I'm a stand for taking care of doctors because doctors take care of us. Matthew and I have broken down today's session into 5 different steps. And the first step I thought that would be interesting to go through is maximizing value. So this particular section isn't really it's for now, even if you're not thinking about immediately selling or exiting, or if anyone in your practice isn't looking at immediately exiting, you'll still get value from understanding this step. So Matthew, is this you or me?
I can start off and then you can chip in if you like.
That would be great, yes.
Absolutely. Well, so as far as what buyers look for, I mean, we look at things as their accountant. We look at from a financial perspective, and then we try to tie that into some of the non-financial aspects that a doctor would look for as well. Essentially, what we see our clients when they're on the other side of the transaction, so they're looking to purchase and what they value in a practice. First of all, it's the principal doctor themselves. How engaged are they and how involved are they in the practice, and how energetic is the practice because of their leadership and because of the way they run their place? And then also, what are their intentions after any sort of transaction going to be? Because an engaged principal in that matter is just going to give greater confidence to somebody purchasing that they're going to be able to take that practice on board further. They like to see the location to be busy and thriving, and as I said, energetic. That goes in with the location as well. Now, it's important to understand what location you're looking for, and are you looking at for a city practice? Are you looking for something in the suburbs or something regional? And they'll all have their different sorts of flavours about them. So it's important to view them through the appropriate lens, but then also see that everything there is attractive. It's modern. There's no need for repairs and for capital expenditure after any sort of transaction takes place. Importantly, you want to know about the patient base. You want to know about the historical patient numbers. How long are they? Are there significant patient drop-offs? Are there new patients sort of coming on board? And what are the demographics of that patient base as well? All of this is really just about reducing risk for you when you're looking to sort of take over that practice. You want to see the support staff and the team of doctors they've got there. Again, you don't want a high turnover of team members. That can be a bit of a warning sign for perhaps a practice that's not running absolutely well.
Or the culture might not be right.
Exactly right. If you've got doctors and nurses and practice managers especially, I think that the best practices I see are the ones where they've had a practice manager there for a very long time, and you can definitely get a feel for the culture of a place and how well a place is run by just by the calibre of the practice manager they have and how long they've been involved. And then IT infrastructure is becoming more and more important, and then just really the systems and processes. They are all about reducing the risk, and we'll get to what that risk plays in the overall valuation formula later on. But all those factors are, if there's going to be a sale take place and the old principle is going to come off and a new principle is going to come on, what's the likelihood that the practice will be able to continue as it was and grow and prosper, or what's the likelihood that it won't be able to generate the sort of profits it's been making beforehand? So from a financial perspective, as an accountant, what we look at really shouldn't be any surprise. We want to see strong numbers. We want to see profit. We want to see cash flow. We don't necessarily want to see growth if that's not the strategy. So we don't get too concerned if you don't want to see too much sort of going backwards or at least unexplained dips in income. But some practices aren't there for growth. They're there to service their patient base and to be stable, exactly. And if that's the strategy and the numbers support that, well, then that gives you confidence that they know, the practice knows what it is, it knows who it's serving, and it knows how to run its own business. You want to see expenditure within benchmarks, and benchmarks being industry benchmarks, other practices, but also prior year comparatives of benchmarks as well. How did you do in 2018? What happened in 2019? If your total expenditure looks consistent is good. And then, we also want to see legal agreements. We want to see documentation in place. We just want to see, one, it's good to have those agreements in place. I'm sure you'll expand on this, Sarah, but also it shows you that the principal owner knows what they're doing and takes care in these sorts of things. Again, it's just a bit of a sign to say they've actually thought about it and done something about it rather than leaving it in the too hard basket. And then, obviously, being from a tax accounting point of view, we like to see things like taxes all up to date, taxes all paid, those sorts of things. Again, they're a bit of a warning sign. It might not necessarily mean that there's financial issues with the practice, but it just means that the systems and processes aren't quite what they should be, because they're extremely important matters that need to be dealt with.
So I made a bit of a list.
Yeah.
No? Why should you know? The value of your practice, the important reasons for doing that, probably
exactly
at different times in your life by the looks of things.
And it's for those who are already in a practice, and normally there's a trigger event. There's something that comes up that says, okay, I need to know the value because of this thing happening, and we sort of listed them all there from an owner perspective, or also a potential owner's perspective. But we also find you need to be aware of the value of your practice, because you can't maximize it if you don't know where you're starting from either. And often by the time someone rings me and says, Matt, I've got this opportunity, I've got this corporate wants to buy me out, or I'm 67 years old and I want to sell out, the best time to have that conversation was 5 years ago, because then we can start going through some of the things we talked about previously and making sure that they're all up to date, and everything's nice and robust. Because when you're going to provide all the information you are to another party, it's going to be historical information. So if you got a sale event happening this year, but events 2 years ago didn't look all that well, you're going to have to open your books up and show all of that. So perhaps 2 years ago, 3 years ago would have been a good time to start having those conversations.
I like to think of it like when you sell a house, you put things in order, don't you? You fill cracks and you paint and you put love into it to make sure that it shows up in the best way that it can. And you want to do these for all of the dot points on the left, particularly if you're an owner.
Absolutely. I guess the key difference though is if you wanted to sell your house within a month or 3 months, you can lay some new lawn and you can patch the cracks and do a bit of a paint job. You can do it quickly. Whereas a lot of this information is a 2 or 3 year sort of process to get things right.
Yeah, and particularly if you're putting governance processes in place and getting agreements drawn up and those sorts of things to tidy your house, for want of a better expression, then you do want to start thinking about that early, because you can't just turn them around necessarily in a couple of weeks. So absolutely. Good point. All right, what do buyers look for?
I think this is sort of what I covered on that sort of earlier sort of slide before. So it's all sort of there, and this is very much a snapshot of it, and it's also very much practice specific. So there might be a practice come up that's got a unique niche about it that falls well outside of these sort of dot points. So it's really about doing a bit of a deep dive and seeing where the information takes you.
So with appropriate IT infrastructure, what does that mean? Does that mean that you're not going to be the subject of cyber attacks? You've got an IT person who's taking care of that. If you're using third-party software, that you have agreements in place that protect you. Anything else?
Exactly right, and it's also about the hardware and the software infrastructure you've got, because there's been great advancements in how practices can operate, whether they use tablets instead of desktop computers, whether they're using cloud-based technology versus server-based or hard drive-based technology. Are they using any other practice management software? Well, they would be using practice management software, but what version are they using and what features are they using out of it? Because there has been a lot of advancements over the last 10, 15 years around automating certain things, getting greater insights into your practice. And some of those insights can be extremely valuable for how you then run your practice going forward, to make sure you're running it as effectively and efficiently as possible. Yeah,
good point. Oh, step 2, the process evaluation. This is also a Matthew question, Matthew step. And I didn't mention this earlier, but if you do have questions as we're going, please do ask them. I'm sure Matthew doesn't mind being interrupted. If it's something that's relevant and it's on your mind, then people can often get more out of it if we answer them live rather than at the end.
Absolutely. So when we look at evaluation, we are looking at as an investment. You'll be wearing several different hats as a practice owner. You'll still be performing a role as a doctor, but you'll have your role as a business owner, and that business owner goes hand in hand with your role as an investor in the business. So ultimately, there's other non-financial and emotional reasons why doctors like to own a practice, and we're completely aware of that and respect that. But they don't engage people like us to tell them, to give them advice around what it means to be a doctor that owns a practice. They want to know what the financial nitty-gritties are, and so that's sort of where we come in. Often we'll say this practice that you're looking to purchase is worth X, and it ends up being a little bit too high or a little bit too low or whatever, and then the client will then make an assessment based on their own feelings. They might say, look, appreciate the advice, I'm willing to pay a little bit more or accept a little bit less because this is what I want to do. And that is completely fine. It's not up to us to tell you what to do or what not to do. We just sort of give you a bit of advice, and then you can use that in your own decision making. So as an investment, it's no different to putting some money into the share market or an investment property or whatever it might be. You've got a capital sum you're going to put into something, and that something is going to generate a return for you. The return we look at is what we call future maintainable earnings, which is and it's no different to any other business. It's not sort of specific to medical practices. The important thing, and in the medical space, we sometimes refer to as doctors' super earnings. The important thing is you're not buying yourself a job. So you don't want to buy into a practice and then earn the exact same thing that the non-owner doctor is earning. You need to have a premium that you earn because you're the owner, and that
because you're taking risk.
Well, you're taking risk and you're investing money. So so we've got to make sure that if we get a set of books for a client who's looking to buy into a practice, we want to make sure that we've completely identified the principal doctor and taken all of their doctor earnings out of that, because that's his job. He's getting paid to be a doctor, not to be an owner in that point. So then we can work out, based on historical information and so forth, what the future maintainable earnings of this practice are likely to be. And then the flip side of that is, how likely is that practice going to be able to achieve those sort of earnings over the future years? And that's where the risk component comes in, I sort of referred to earlier. So the more stable, the more consistent, the more systems and procedures and good staff and everything that practice has, the quality client base, the great location, the good IT infrastructure, if all of that is top notch, then you can have some comfort that the $300,000 of earnings that practice made in 2020 is likely to be earned in 2021 and 2022, and most importantly, be earned by a different owner of the practice than the previous owner, because there's no value in a practice where all the earnings are attached to the owner doctor who may walk away. So it's really a combination of the earnings and then the risk, which we then convert the risk into a capitalisation multiple. We multiply the two of them together to get the value of the practice.
That's so useful. Who
do we get involved?
Who gets involved? That's right. In the valuation process.
Absolutely. So the valuation process, and also the process, I guess, to the point where a deal can be done. Certainly we get involved, and we get involved mainly in reviewing the financial information, sitting down, talking through the opportunity and whether it's one to pursue or one to leave aside. And I'll say now, we leave aside plenty. We get plenty of deals put in front of us. We do the work, and then we sit down with the client and we say it's not the deal for you. Again, going back to the buying a house and analogy, you don't buy you don't go on the first weekend you're looking to buy a house and you buy the very first house that comes on board. You've got to take your time, and you've got to assess based on different opportunities and so forth.
What I think can be different from a buyer's perspective, maybe of a business, is that if you don't go ahead, you can feel like maybe there's some sunk costs or costs that you've spent that you won't get value for if you don't go ahead with the deal. But sometimes I think there's one that we've worked on together, Matthew, where it was a much better arrangement for this person, rather than to buy a practice, to start a new one on their own. But they had spent money, and I suppose it's hard to see that as an investment sometimes, even though it is, if it's not the right opportunity, isn't it? Because you've spent money to save yourself a lot of time and anguish potentially by buying the wrong practice.
Absolutely, and that's where the banks and financiers come in as well, because at the end of the day, a deal will need to be funded, and the cold hard reality will come into play after settlement of, you now have this practice that supposedly generates this amount of cash for you, and you've also now got this obligation to the bank to start paying down some debt. So part of the cash flow forecast, which I've listed there, will often convert those future earnings that we referred to in the previous slide and say what sort of cash is the practice going to generate for you on a month-by-month basis? What do the bank need to be paid to satisfy the debt there? What's left over? What needs to pay the tax? What needs to come out as drawings for yourself? How does that all sort of fit in together? And what we often find is, especially in the first 12, 18 months, there's not a lot of cash being created after everything is accounted for that way. But then over time, things start to get a bit better as debt gets to be paid down, interest costs come down, and so forth. So that sunk cost, which is an issue, we can change the thinking a little bit to say, look, this is what your world would be if you bought into this practice that you acknowledge is a little bit high and probably not quite right, but you've already spent X thousand dollars on accounting fees and legal fees. I feel like I need to do this. Well, it's a much larger investment after that point. So you really need to eyes wide open, know exactly what you're doing if you're going to take that next step.
We've got a question. Would the value to the potential buyer be reduced if they are the highest generating doctor and contribute the most to practice earnings? And that's from an anonymous attendee.
Yeah, absolutely. That's a very good question. So what we're sort of referring to here is your general, what they say, eager but not desperate seller and eager and not desperate buyer, and a deal getting done between the two of them at a market rate that suits both parties. But often you'll have a buyer and a seller that have different characteristics, different needs. So for example, a corporate, for example, can offer purchase at a higher rate because of their scale and because of their processes and back office systems, they can normally extract better value out of a practice than what a single owner doctor can do. In the sense of a high earning income doctor, you would need to consider if for the principal doctor who's looking to sell is a bit of a reward mechanism there and a bit of a risk mitigation strategy in that if I'm not going to sell to this high earning doctor, they might seek to go to another practice where they're going to get that opportunity, and so the deal needs to be sort of made a bit more favourable to that particular doctor. It doesn't necessarily change the calculation from this point of view, in the sense that a high income earning doctor, they still earn their income as a practicing doctor in their own right, and then would pay either the service fee component or however they're structured into the practice. So and that service fee income belongs to the practice. So it does fall within the future earnings of the practice. However, what it does is it will adjust that risk factor, in the sense that if a deal doesn't get done, there's a potential risk of a talented doctor sort of going elsewhere, and so that will come into play in the negotiation setup. Yeah,
sometimes the buyer will bind that person to work for 3 years or 5 years or on an ongoing basis. I suppose if they're happy, they don't have to leave after that time. But yeah, and then it can be the best result for everyone in that case.
If a practice has a talented, high achieving doctor working for them that's only involved in an associate type arrangement, it would be a good risk mitigation strategy, a good succession planning strategy if they'd identified that doctor to be somebody that they want to keep for the long term, to get them involved in an ownership discussion, and often doing some sort of discount on the purchase price will be more than rewarded by having the long-term certainty of having that doctor into place. So those factors come into the negotiation process, but it's certainly something that I would certainly put forward if I was acting for that particular doctor.
Great, thank you. Shall we keep going?
Absolutely.
Who else is involved?
Well, I haven't mentioned you, Sarah. So the lawyer, now the lawyer comes in place because obviously when a deal seeks to get done, there's a lot of documentation, and it's not just the simple buy-sell document. There's also sure you'll go through them later, but employment contracts, there'll be leases, there'll be associate agreements and so forth. So when you're buying into a practice, you're also buying into all the relationships and agreements that come into play there. So you want to make sure that they are as they should be, or if they need to be updated, somebody to update them for you. And then also the structuring advice and establishing entities, you just want to make sure that you're structured absolutely 100% correctly from the get-go, because to change things later on can create all sorts of issues, not just from a tax point of view, but just from an administrative point of view, and changing around, you know, details with Medicare and details with the landlord and so forth. So it's absolutely essential to get it 100% right from the outset, so the lawyer can help to make sure that's established properly.
Got another question. Would it be advisable to put in place in the contract a number of KPIs over the following 12 months after purchase, I assume to protect the buyer from doctors leaving and I guess a dip in income generally?
Yes, absolutely. So what we often see in many business sale transactions is you've got the transaction that happens at settlement, but then there'll also be some sort of conditions that apply later on, in which case the selling party doesn't necessarily receive all the income right at settlement. They might need to, they call them earn-out provisions. So they need to earn a certain amount of income, or just at least just stick around, just be there for the next 6 months, 12 months, 2 years to hand over. And we're just going to hold a little bit of that back until we make sure you do that, because there is a risk, and I have seen it before, where on Monday we settle and on Tuesday we've got an issue because the owner doctors got their money and now they've completely checked out. So and I find that sort of discussion, it can initially be confronting sometimes for the selling doctor if they hadn't considered it. But when you actually explain what it's all about, they can typically understand the reasons for doing that. And the reasons purely are that we're trying to reduce risk for the new incoming owner doctor. And in reducing risk, it means that practice is going to continue to have a legacy, because the worst thing that can happen is the new practice owner comes on board and the place just falls apart because there hasn't been an appropriate handover, and then that practice that the old owner had built up is no more, so that nobody wins from that one.
Good question. Are we done with this slide?
I think we might be. Yes.
Great. Let's move on. How does evaluation happen? And do you just do it from numbers and historical numbers and the forward planning that you talked about, or like
sure.
What do you do?
It's a starting point. It's a starting point, and there's we're very careful not to give the back of the envelope type of, or the rule of thumb type of valuation. I mean, you can normally get a bit of a feel as to are you dealing with something that's going to be $100,000 or $10 million. You can at least sort of get a bit of a ballpark guideline there. But until you do the deep dive into the information, a bit like the deal we sort of talked about before that you and I sort of worked on, it wasn't until we actually dove into the information there that we realised that something wasn't quite right. And then further investigation meant that if the client had bought into that practice as they had planned to, that they would have been into all sorts of financial trouble. So the financial information, the financial statements of the practice you're looking to buy into, that's really the starting point that we look at. And it is on the basis that the past history is the best estimate of forward performance. Now, having said that, if there has been something happen in the past that is extraordinary or abnormal, you want to be able to identify that and allow for that in some of the analysis that you do. But if it's a practice where the last 3 years look not that much different to the 3 years before that, well, then you can have some sort of certainty that you can come up with a calculation of the earnings that you need to for this. And again, what we're looking for here, but we'd normally ask for copies of prior years for financials. What we're looking for is mainly consistency. And that might be consistency as in flat revenue, or consistency of solid growth in revenue. Sometimes extraordinary growth is a bit of a concern because it just doesn't have that weight underneath it. So you need to investigate that a little bit more. But certainly set of financials that look like that are far better than a set of financials that look like that.
Yeah.
The different income streams for a practice are relatively consistent across the different practices we look at, but it's not just about patient billings. We want to look at the model of the practice and what's coming in as patient billings versus service fees. incentive payments, making sure they're making use of all the incentive and payments available to them, and sublease arrangements as well. Just we want to see what they look like, but also how long the tenure is further to go on some of those arrangements. I've put there in yellow just so to sort of bring it out, because it is the elephant in the room at the moment when we're looking at practices and so forth, is there's been a lot of money thrown around to all sorts of businesses in around Australia, no matter sort of what sort of business you have, and so that will be recorded in the financials. Now, the cash flow boost, for example, was a payment of up to $100,000 over the course of about 6 months. That was just a payment with no contingencies, no requirements, except you had to be an employer and have wages over a certain amount. So that's clearly not an amount of income that's going to apply every year. It was a one-off. On the flip side, there would have been a lot of costs, a lot of dip in income associated with COVID over the last almost 12 months now. So it makes the assessment extremely difficult. You need to do a little bit more sort of analysis and work into the numbers around how that sort of impacts. But we just want to make sure it wasn't for medical practice, but it was for a business I looked at just last week, where the information memorandum for this business included the last year's financials and recorded a great profit for 2020. It just included the cash flow boost and JobKeeper, and so we just had to add that back ourselves into there. And the advice on that one was perhaps our assessment of the value was a fair bit under what the vendor's assessment was there. We review expenditure on the same mark, and also adjustments for what in quotes non-business items, because especially where it's a one owner operator, often you might put your own motor vehicle in there, you might employ the kids or the spouse to do some work for you, you might own the premises as well, so it might just be a token amount of rent that goes in there,
or a super large amount of rent.
Could be either way. So as soon as we know that the premises is owned by a related party, it's just important to get that appropriately valued, so we know exactly what we're dealing with. Even if the vendor says they pay market rent, we want to get a third valuation on that one. So again, what we're looking at, we want profitability. Profitability improves your return, and we want that reliability and consistency, and that will reduce the risk. And in both of those, that will increase the valuation. So
something I get asked is how does goodwill apply to a valuation? And maybe goodwill is that second part, the reliability and consistency, and that's also where you get why have a good culture? Well, it helps with that second element as well, doesn't it? Having a cohesive team that doesn't change a lot and that enjoy working together. Then even if that's not really easily attributable to the profitability part, it's absolutely relevant for the reliability and consistency part.
Exactly. And when we're talking about valuation, we're talking about the business as a whole. So a business will have tangible assets and intangible assets. So tangible assets are assets that you can touch and on a register you can identify. The intangible is the goodwill. So you want to make sure that if you're buying a practice, this is the total amount you're buying. It will include some of the tangible and intangible amounts, but overall, those tangible assets are there to generate an income for the practice, and so they contribute to the whole of the practice valuation there.
So I've got a question here. Oh, there's two. I knew that this would open a can of worms. Does the goodwill need to be agreed by both parties so it's treated consistently by both parties?
Yes. So well, first of all, the sale price has to be agreed by both parties. That goes without saying, because the deal won't get done otherwise. The contract that Sarah would prepare would often stipulate, of the practice we're buying, X amount is for the plant and equipment, fixtures and furniture, X amount might be stock and consumables, and Y might be for goodwill. From a tax perspective, it creates a bit of a dilemma, because from the purchaser's point of view, they want to pay as little as possible for goodwill and as much as possible for stock or for capital equipment, because they get a better tax benefit out of it. Flip that around, if I'm the vendor, I want most of it to come to me as goodwill, because then I can get some capital gains tax and potentially some small business concessions to apply to that. I don't want it so much in stock and inventory or even depreciable assets, because I might have to pay tax on that. So you've got this bit of standoff here where we might have agreed on the price of the deal, but this party wants goodwill up here, this party wants goodwill sort of down here, and often that's a conversation that happens late in the piece anyway. So it makes for interesting negotiations, but I've never seen a deal fall apart because they can't agree on that.
That's good. Mike says, how do you calculate the goodwill?
So the hard part's calculating the business value. The easy part is then saying goodwill is a combination of your tangible assets and your intangible assets being your goodwill. So in that and the situation I talked about before, it might be that the plant and equipment's got a tax written down value of, let's say it's $100,000. So we'll say that's the value of the plant equipment. Everything else is goodwill. But another scenario might be we get a valuer to value the plant and equipment, and they just they value it at $50,000 because there's just a bit of an imbalance between market value and tax value. So it's really just the value of the goodwill is the business value, the practice value, less the value you assign to plant equipment, furniture, fittings, etc.
And do you find that, this is another question, do you find that buyers would want more in plant and equipment because then that's depreciable and the goodwill's kind of a bit intangible? It feels like a bit of art and science, and it's not really something you can touch or feel, is it?
Well, what we see is it comes down to a tax perspective, and from a buyer's point of view, especially with these instant asset write-offs that are available at the moment, if we say a $500,000 deal is $200,000 plant and $300,000 goodwill, then that's $200,000 that you'll be able to write off your tax straight away. Whereas if it's all goodwill and plant equipment's deemed to be nil because it's all old and if you're not going to use it, you're just going to chuck it out. You're not getting any tax deduction at all. That $500,000 goodwill component just goes into your capital gains tax calculations when you sell it well into the future. So that's where that sort of imbalance comes in. But certainly from a purchaser's point of view, they'd want to get as many tax deductions on the acquisition as much as possible.
So someone says, due to the instant asset write-offs over the past few years, the written down tax value could be zero. Accounting written down value could be better representation of the true market value of the P&E.
Absolutely, and we make sure that the financials we prepare, well, we're doing it before, but certainly instant asset write-off has just highlighted the need for it. Is we still in the balance sheet of the practices we look at, we depreciate using the general rates. We do a tax adjustment for the instant asset write-off, so that way the financials of the business record that the plant equipment and so forth at an accounting written down value, which is generally going to be more than what the tax written down value is going to be. But what that does mean, though, from a vendor's point of view, if they've written down everything for tax purposes to nil, but the accounting written down value is $200,000 and that's what they receive on the contract, they've got a $200,000 recoup depreciation, which is income, which they need to pay tax on.
So one more goodwill question. I might hold the rest to the end, but how do you calculate the goodwill component, Mariola has asked?
Yeah, so I think we sort of covered that before, but essentially the hard part is the practice valuation itself, which is the valuation of everything as a whole.
Yes.
And then the distinction between what's goodwill, what's plant equipment and so forth is really just a mass calculation between the two of them. But I guess the goodwill, in a sense, is the more important part is the actual value of the practice, because it's the practice that generates the income that
that's the asset.
Pays the expenses. That's the asset, and goodwill is one component of that. It's the major component, absolutely, but there are some other components to it too.
Thank you. All right. How? Practice information.
Yep.
So Mariola's just asked, how do you calculate the whole value of the practice? Well, this is what we're talking about now. And if you do need to go back and start again, then we're covering it all right now. And this is a good summary. So
Yeah, and look, this is sort of the over and above the financial side of things. You know, what else are we sort of looking at beyond the financial statements of the practice? So again, we want to get an understanding of the location. The first, or combine the first and last dot points there. We also want to understand the lease and the lease arrangements there. If it's a premises that's got a lease that's going to expire in 18 months and there's no renewal in place there, well then that's a bit of a concern, a bit of a risk.
And in some cases, parking in relation to those two items can be very important, can't it?
Parking, capacity to grow, which we've got on there as well. So I was having a chat to a client who's a veterinarian just the other day, and he owns his practice. And we're just sort of talking about if he wants to grow and he's got the capacity to grow in the business, in his systems and client base. He just doesn't have the capacity to grow in rooms. He'd love to have another room to grow into, but he's limited in that regard. So it's understanding that if you're going to if you want to buy a practice because you think you can double the size of it in 5 years, but it's sitting on a tiny block, then you know, the two don't sort of marry up, and so you just need to maybe sort of check what your strategy is, or perhaps look at other opportunities. You want to review the patient numbers and the Medicare billing numbers, just to get a feel for the practice, a bit the culture of it. You know, is it a bulk billing practice? Is there some private component to it? You know, is it an older client base? Is it a younger patient base? Again, utilisation of those incentive payments, because they can be exceptionally strong contributors to growth. In fact, often the incentive payments and the pathology sublease are the only reason practices are making a profit. So you want to get an understanding of all of that, just to make sure that they're doing everything they can, or what other opportunities are there to make more income. And then the service fee percentages they're charging to doctors. Where is it in the market? Is there a risk that some doctors might leave because that service fee component is too high?
Putting it all together. And maybe Mariola's also said, is it possible to have an example of one particular practice, or an example practice on how the calculation would be done?
Yeah. What I'll say to Mariola and anybody on this call, my details will be at the end. I'm more than happy. I was going to say, Sarah, as an accountant, I'm extremely disappointed there's no numbers in this presentation. So, but I'm happy to sort of talk and then talk through the specifics of the numbers, because if we start getting into that level of detail, we'll be here all afternoon.
Yeah, I know. We got 15 minutes to go, everyone. We know your time is money.
So pulling it all together, and we sort of started this at the slide, the initial slides, but pulling it all together. Future maintainable earnings, that's what the practice is generating once we review the financials. That might be $300,000, for example. The capitalisation multiple, if we're looking at medical practices, it's somewhere around 2 to 3. Sometimes the corporates I know are paying up to 4 or 5 with considerable conditions attached to all of that. So to give you
so you just answered Denise's question, which is, what are they generally selling for if they've got excellent culture, earnings and location, a good capacity to expand? So the answer is, which is a lawyer answer, it depends, but 4 to 5 times, sometimes more, in a multiple of profit.
If it is an absolute blue ribbon practice that everything is going as well as it possibly could, you could squeeze it up to 5. I know the banks will assess and fund acquisitions at a 5 times multiple. On the flip side of that, if you've got a country practice that's got a 1 or 2 doctors in there, and they're in a small community town with not a lot of opportunities to grow, then often they're at the 1 or 2 stage. They're very, very hard to sell those practices. And
another question, do you add back depreciation when you're calculating this?
Yes, we do. So there's a few add backs. We add back depreciation, because what that does is it beefs up the profitability numbers, which then in turn allows so it'll increase the future maintainable earnings, which will then increase the practice value from that formula. And what that means is then that value encapsulates your tangible assets there. Great,
thank you.
That's all right.
All right, step 3, steps to sale. So I often get asked, what are the steps if I do want to sell my practice. And so I've broken it down really into simple steps. Often, particularly if a corporate is buying a practice out, they will issue a heads of agreement with the terms that they are willing to purchase the practice on. And, you know, the value of your practice might not just be how Matthew's talking about it. And if you've got a good person who's negotiated well on the other side, they might have seen something that is of value to you that maybe you didn't even know. So maybe they'll pay out your lease for you to be able to move over to work in their practice. And you might not have even thought about that cost disappearing, and that can add a whole lot of value and remove a lot of stress for you. So heads of agreement, we often see that first, and then there's a sale agreement, and a sale agreement can be of assets, so just the assets of the practice, or shares or units. They might buy the whole of the entity, which can often be a lot simpler. And as part of that sale agreement, if they do want you to stay, you might also get a practitioner services agreement or an associate agreement, as Matthew says, to stay. And that might be what in the corporate legal world we call golden handcuffs. You get your payout, but you need to stay there working with this new owner for a certain period of time. And as Matthew said before, that increases the stability of the firm often, or practice often, and you get to work without the risk and with putting your capital investment into another investment, not the investment that you have it in, which is the practice. And then Matthew mentioned before, there are many practices where the owners own the building or the land in which the practice is run. So that lease might be transferred over to a new buyer, or if you're very lucky, and in another case that Matthew and I worked on together, the building that the practitioner wanted to purchase, so we were acting for the buyer, was extremely valuable. It had gone up in price exponentially over the time since the doctor first bought it, and our client couldn't afford it. So there was then a lease back option, and that former owner got the option to continue to get rent from the building until the other doctor established themselves more and was in a position to buy out the building, if that's what they wanted to do, because that's just another kind of chunk of your capital that you're putting into a different type of investment. Definitely worth getting specialist financial advice before you do that if you are wanting to buy a practice, I think. All right. And then internal sales. So you might have an up and coming doctor in your practice that you want to sell out certain shares or units to, or if someone's leaving, someone else might be buying that other doctor's shares through an existing owner or a new incoming owner. So your most important document in that case will be your owner's agreement. In some cases, we do still see partnership agreements, Matthew, but most often nowadays it's a shareholders agreement or a shareholders agreement and a unit holders agreement stapled together. And those agreements will set out the process which people sell out and buy into your practice in. So it's really important. And then as part of that, if people are leaving, then we'll usually prepare an exit agreement. And if they are going to stay on as a consultant, or they're going to be still working as with the practice, they might have had an associate agreement that was appropriate for when they were an owner, and then that might need to be changed and be slightly different if they're no longer an owner and they're still going to be working as a practitioner. All right, I've got a question. Is it normal to have a buyback clause in the shareholders agreement? It is relatively normal, and Denise, that can also be a separate agreement. So we see buy-sell agreements as a separate agreement a lot of the times, and that document will set out in what circumstances you might sell or buy, and it's often backed by an insurance policy as well, so that if something happens and you get hit by a bus one day and your family members in the ordinary course would then become a shareholder, you can have this agreement that goes in between that, which means that your shares then get paid out as part of that insurance policy to your family, and the existing owners don't have to worry about being in business with somebody that they never signed up for, or somebody who's not a doctor and can't contribute to the practice in the same way that you could have. I hope that makes sense. It is a confusing area, and often people don't like thinking about the worst case scenarios as well, particularly about your own business and yourself. Even though doctors do deal with people's health all the time, it can be hard to imagine something happening to yourself. Oh, Denise, good, answered. Excellent. Thank you. All right. Oh, where did that go? Forward, not back. Oh dear. Oh, the conflict between outgoing owners and remaining owners. So I mentioned that earlier in the session, where the outgoing owners can be wanting to maximize the value of the practice so that they get paid out an extraordinary amount by the existing owners. And that can create some tension personally, because you might not see that you're all rowing in the same direction anymore. And I don't really have any answers for how to deal with this, but I think it's important to be aware of whether or not you're the outgoing owner or a remaining owner, or even an incoming owner. Have you had any experience where this has been an issue, or anything worth mentioning, Matthew?
Yeah, I have, in the sense that the process to get to a business sale, get to settlement is a complex process, and there's normally a lot of negotiation and sometimes good-natured argument that leads along the way. And you can often get a feel for how any potential conflict after settlement by the way people conduct themselves in the lead up. So I'm a big believer in going with your gut sometimes as well, that even if the numbers all line up and it looks like this deal can be done, if throughout the contract process, if you're just feeling like the other party's not being reasonable and you can't work with that person, then it's never too late to pull out until you've actually signed everything.
It is a red flag, isn't it? Especially
Absolutely.
If you're going to be working closely together for what you hope is many years in the future.
Exactly.
Good point. All right, quick recap. So our top 3 points are, so far we know we need to maximize value, and you can start that as soon as when you're thinking about even starting a practice. Engage in the process of valuation, which hopefully we understand a lot more now than we did when we started the session, and then go through the steps to sale or purchase, depending on what side you're on. So getting ready, step 4. Basic information that's needed. Matthew, you're the finance guy. Do you want to talk about this? I think definitely not having any tax surprises will be very important. So getting your financial statements up to date.
Absolutely, and look, I won't go through them in sort of detail just for the benefit of time, but there's a list there that's the starting point. That if a client of mine was looking to sell their business, you want to make sure you've got those all available. Sometimes we'll wrap that up in an information memorandum, especially if there's going to be a number of different potential buyers. Mm-hmm. You can package it all up so that way, as soon as you've got an interested buyer, you can strike while the iron's hot, give them everything that they need in order for them to pass on to their advisors to make a decision as to whether they do a deal or not. But having them all available and ready to go just means that you can act quickly, and obviously having your financial statements actually all ready again shows that you're on top of everything and everything's as it should be. The one thing not listed there as well, which especially for somebody who's looking to sell their practice, that they need to be on top of, is any potential tax implications that come from a sale as well. So the major tax to be aware of is capital gains tax when it comes to this sort of transaction. Mm-hmm. There are a lot of concessions around the small business capital gains tax concessions that are complicated but extremely lucrative if you can fall in within them. Mm-hmm. So importantly, making it important to understand whether they apply to your situation or not, and if they don't apply yet, are there any things that you can change to manoeuvre yourself into them over the course of a few years might be helpful as well. So just getting that sort of advice before you sign a deal, so you know exactly where you're playing from a tax point of view is vital.
That's a good point. So yes, this is the point also where we I guess we did talk a bit about getting your house in order and preparing it like you would a house for sale, but sometimes that taking longer. So if you don't have doctors on agreements, get them on agreements. If you don't have employment agreements that are up to date, when you're bringing on new team members, make sure that you've thought about that. You'll have a lot of things are done as part of your accreditation process. So the processes and procedures and policies and those sorts of things, but making sure that you're onto that, or your practice manager's onto that, or someone in the office is prioritizing those so that you know that the business is running smoothly and is legally compliant is my big one. Someone said here, Matthew, I'm not sure if you know the answer to this, but there are some medical practice valuers out there who are not accountants, and they do secret site visits as part of due diligence. What are your thoughts, and what services do you provide when valuing a practice if you're representing a buyer? Are you part of the negotiating process with the other party's accountant?
Yeah, so I don't know if I've ever done secret site visits, but certainly a site visit is usually a non-negotiable, especially if it's a site that's quite easy to get to, and you know, sometimes for regional and outer regional practices, the client might be happy to they might do the site visit themselves and prefer to us to just do things from afar there, but. So when a client, and I guess we're talking about perhaps a potential purchaser is engaging us, we can play a number of different roles depending on what the client's needs are. At the basic level, we can review a set of financials and some financial information and just give them a bit of advice regarding the value, an assessment of the valuation rather than the full valuation itself. Often, the selling practice might have had their own valuation report done, so we can review it on the client's behalf and give our recommendations and thoughts on that. And then often we'll get involved in the negotiation process often with the other accountant for the other party, and that's just really when my experience in negotiating with other accountants is we go back to that formula we had at the start. We say, okay, well, I think future maintainable earnings is X. You think it's a higher amount. I think the multiple is lower because of these factors. You think it should be higher because of these factors. We try to understand where our differences are and then work out, okay, where do we fall? And it's a bit of a cliche, but it's true. You sort of end up sort of somewhere in the middle. And if you are a purchaser, you do want to put a low bid. And if you are a vendor, you do want to have a high asking price. But that's part of negotiation. If you put in too low a bid, you might offend the vendor, or you might miss out because there's another person.
Finishes, yeah.
So you've got to be strategic with it, but also be respectful as well. And if you're going to put an absurdly low bid, just because you think you're being clever and you're going to get a good deal that way, as I said, you might just offend the other party, and they might not want to deal with you after that. So
that's true. All right, we've got 2 minutes, so I'm going to go through step 5, which is leverage an expert. Using an expert can bring you new ideas, best practice, and accountability. There's already new ideas in your head right now that wouldn't be here if you hadn't made the time to come today. I know I've learned a lot as well. So remember, you don't have to do everything yourself. We know doctors do love doing everything themselves and really understanding processes, but I think even just from listening to Matthew today, you can see how much doing the same thing all the time can add value to you in understanding the different sort of outcomes that you might expect from any process you embark on. So here's a summary of my 5 steps. The first one's maximize the value, then it's the process of the valuation, steps to sale, so you understand that, so it's much less mysterious if it ever does come or when it does come. 4 is get ready, get your house in order, and 5, leverage an expert. We don't have time for any more questions, I don't think. We could go over time, I suppose. But let me just go through how you can get in contact with Matthew now in case you would like to. He's always happy to have a chat. So here are his numbers and email address so you can reach out directly at a time that suits you. And my request is that if you haven't already, you can join my Facebook group, You Legal for Doctors. It's free to join. There's almost 1,000 people in there now. It's grown exponentially over the COVID period, which has been great. We've been doing a lot of giveaways for practices and hosting events like this in there as well, so that if you haven't registered, there's still an opportunity to watch it back if you're part of our community. So feel free to join. Someone says, thank you, this our anonymous friend. They do have one question. Should an existing sole owner of a group practice be transparent to existing non-owner associates if they're planning on selling the practice? It's probably not a super easy answer. There's probably lots of nuances in that.
It's not. I would say, and correct me if I'm wrong, Sarah, but from a legal perspective, and certainly from my experience, I don't know if there's any requirement if you're looking to sell to a corporate. So if you're the owner and you want to do a deal, then you do the deal. You don't need to involve your employees. You don't need to involve your doctors.
Actually involving them can be very distracting, because imagine you're going through this process and it doesn't happen, and you've got your doctors wondering what's going to happen. It can be quite destabilizing, I think, for other doctors and also for other staff. So I'd be erring on the side of caution and not doing that.
But I would counter that to say, especially if you've got some associate doctors working for you who might have the belief that they have ownership in their career path at your particular practice, you might get them offside if you bring a corporate in, for example, or you sell to a completely other party. So you've really got to understand the needs and the future pathways of the doctors you have working for you.
Yes, because if them buying the practice was an option, they might prefer that to selling out to a corporate or selling out to somebody that they don't know.
Yeah, but ultimately it's your practice, it's your deal to be done. The way you manage the communication piece with your doctors and your staff, often what would happen is once you sign the contract, you tell the staff and tell them what's happening, because they'll need to get involved. They'll have a new boss effectively. So you just need to get them engaged in the process. And from their point of view, there's often a bit of fear and uncertainty around that. So just keeping communication channels open at that point is vitally important. But Sarah's completely right. You don't want to get them involved too early, because it'll destabilize things, especially if you might get 3 or 4 goes at it before you actually find the deal that actually happens. So if that might take 2 or 3 years, and in that time, your staff might decide that they want to go somewhere else that's a bit more stable for them.
Well, thank you for joining me today. It's been a great session.
That's great. No, thank you, Sarah. I really enjoyed it. It's great.
Excellent. All right. Well, thanks everyone for coming along. We'll send out the recording again, so if you do want to watch it back, then you're welcome to, and Matt's contact details will be on there as well. So if you missed the slide, you haven't missed out completely.
Thank you.
See you later.
See ya.
Bye.